Hello everyone and welcome to the last video of chapter number 1. In this video we are going to do the last topic of chapter number 1. Along with that we will also be solving the examples which we came across when we were doing the lectures of chapter number 1. So let's start. If you come to the page number 11, you will see the first topic of this video, that is encouraging the achievement of stakeholders' objectives. Now before going into this topic, I need to draw a diagram for you so that you may have a better understanding about this topic. So suppose there is an organization or company. Here we have a management. Management involves seniors management, directors, and one of the objectives of organization is towards the stakeholders. Now stakeholders, we all know who they are. Stakeholders includes shareholders, trade payables, trade receivables, employees, tax authorities, and also government at large. So these are our stakeholders. Now they have certain objectives from the organization, and also the organization incorporates those objectives if it wants to stay in the business and go perform in the long run. Now for that, the management objectives should also be in line with the organization objectives, because most of the times management comes and goes within a 5 to 8 years span. They do not have a very wide time span in an organization senior positions. So they sometimes try to achieve short-term objectives at an aggressive pace. To eliminate this, we need to have some level of goal congruence between the management and the organization. So what we need over here is goal congruence. And this is the reason we are doing the topic which we are have to do now. This is the reason behind this topic which we are doing. Goal congruence is accordance between the objectives of agents acting within an organization and the objectives of the organization as a whole. Now agency relationship, you must have already studied about it in law papers. Agents implies the senior management. They are acting as an agent for the company. Now their objectives should be in line with the organization's objectives. That's what this paragraph is telling us about. It is argued that managers will only make optimal decisions if they are monitored and appropriate incentives are given. Now it's only basic that in order to motivate the senior management, you need to keep some sort of incentives for them. It's on the principle of basic of reward and punishment. If they are to be criticized for the bad decisions that they take at the board level, they should also be appreciated and rewarded if they move the company in the right direction. Now for that, there are a number of ways. First is performance related pay. Simple as that and straightforward. It happens in most organizations that if they achieve a certain level of performance, for example, any threshold can be put in place. For example, if a share price increased by, let's say, 50% or 100% in a year performance, or 200% in a year performance, they will get an incentive of they did this much amount. Senior management are paid handsomely. After that, we have got rewarding manager with shares. We can also this is perhaps the most or widely exercised practice in senior management. What organizations do, with the organization implies senior management, other senior management apart from the directors. So what what they do is actually they reward themselves with shares. Obviously, in this way they have a long-term incentive in a company, and they do not just go. Even if they come and go for a short time, they will still hold those shares, and their performance will have an impact on those shares. So it's best if we get them the share. If they perform well, not only that they will be appreciated, but the shares which they are being offered or they are given will also increase in value, and as a result their wealth will be increased. After that, we have got executive share option plans, which means if they want, they can buy the shares in the company at a reduced rate or as an incentive to the senior management. Now, these sort of pay related and share options plans have advantages and as well disadvantages. Advantages, they act as an incentive to achieve good performance level. That's the basic thing. It's obviously the reason why we put this plan in the first place, to get the best out of them. Now, the second advantage, schemes attract and keep the employee valuable to the organization. If they value the organization, if those directors, instead of moving forward or going into the bigger companies, they tend to make that company in which they are being at a director level, make that a big company. If they have an intention of doing that, then these schemes help them keep them in the premises, in our doors, in our organization. It helps communicate the exact role to employees, creating organization success. Now, these plans also make employees more involved. They increases the cooperation of the employees and senior management in the affairs of the organization. It's not just doing plus and minus and coming at 9 and leaving at 5, don't know where the organization is moving. These sort of incentives actually help employees and management to achieve to consider the wider perspective of the organization's existence. After that, we have got schemes that are keeping focus on continuous improvement. They keep the employees and senior management on track where they want to head, and after that they can motivate employees or managers to act in long-term interest of the organization. Again, that was the initial reason why we make these arrangements. Now, like that, there are disadvantages. It can encourage dysfunctional behavior. Dysfunctional behavior involves what the function should be, and what in order to achieve those objectives, they might try to override control. They might try to overlap the performance of another functions. So these sort of things might happen. It's a chaos thing, but it could happen. Decisions can be made by managers that contradict with the wider purpose of the organization. If the senior management comes for a short time span, they will initiate those plans which benefit the organization in the short term and not in the long term. Perhaps in the long term, it may go against the organization policies. Still, they will imply it because they want to get the return. Short-termism will be favored against long-term objectives. However, a scheme of long-term achievements may not motivate employees. If the reward is very far away in a distant time span, obviously if my performance is being rewarded next year in the same period, it kind of creates a demotivational effect. What it will take a long time for me to get this reward. How may I keep on the current level of performance if I'm not getting rewarded on short-term basis, rather I'm being rewarded on a long-term basis. These sort of things have a psychological effect on the but obviously the personnel who value the organization will not face such dilemmas. After that, we've got no scheme can provide a comprehensive assessment of what a single person achieves for an organization. This is a fact. No company in the world can claim that they know exactly the level of performance which each employee is contributing toward the organization as a whole. No one can do that. It's a team effort, and every person from a janitor from you can say the security guard of a company to the director have their share in those in the organization. So there is no individual assessment of how much the guard has performed for the company, or how much the director has performed the company. It's everyone's responsibility, and everyone is a beneficiary and holds the responsibility towards that. So there is no comprehensive assessment. There is no technique to evaluate there. After that, we have got a may compromise on teamwork. If this happens in most organizations, if the assessment is on its assessment of individuals is highly on the personal individual performance levels, instead of the best way to counter that is, instead of comparing them with other employees, that this guy Mr. X has performed this much this month and you have performed not well this month, why don't we give them uh, an assessment based on their past assessment? Simple as that. This will eliminate the competition system. The last month you have performed this well, in the current month you have performed this, your what you can say, the progress is somewhat steady or has increased or has decreased. If it is decreased, then you should tell them that they should at least keep the moderate level of or at least the same level of performance. If it has increased, you should incentivize them, give them reward for that. Instead of comparing employees, this creates a problem. They do not act as a team. If they are being assessed on their individual performances instead of comparing with other employees, if they are being compared with their past performance, their main objective is to improve their past performance and not the not to affect the other person's performance. So they will act in a team to achieve that objective. May have had effect on quality. That's one of the most basic thing. If these sort of incentives, if they are very long in time, they can have a great quality impact. At the short termism, employees may lack the motivation in the short term to improve the quality of the work. Standards and targets may have to be lowered to maintain quality, bringing scheme purpose back to square one. Now, in most cases, it has been observed that when the targets are set, in the end, management seems, because of certain circumstances, whether internal or external, and management is unable to achieve those targets, then they start to get demotivated, and as a result, in order to keep everything in the system, management lowers the target, and gives them the incentive despite the fact that they have not achieved the required level of performance. So what this creates is what was the scheme's purpose in the first place. Now the question arises, why we have that scheme if those performance objectives are not met? Then what's the reason behind making or giving those incentives? They undervalue intrinsic rewards. So that's the last point. Intrinsic rewards, they undervalue those intrinsic rewards. Now the next point is regulatory requirements. Now the achievement of stakeholder objectives can be enforced using the regulatory requirements such as corporate governance code of best practices and the stock exchange listing requirements. Now one way of creating goal congruence between management and the organization is via giving them incentive, and the second is by strict letter of the law. In fact, why don't we put that in a chart? Now this can be achieved by giving rewards, which we have just covered, and by regulations, which we are about to cover. First is corporate governance code of best practices. If you are not familiar with the code of corporate governance, let me tell you, this is the requirement of most of the Securities and Exchange Commissions across the world. It requires, it is the best practices conduct, which is being done by, which is being assessed by the respective Securities and Exchange Commissions across the globe. The main purpose of this is that directors, there should be a segregation of duties. So directors do not hold unfettered power. They are held accountable, and all directors and employees have a fair chance. So these sort of things are incorporated in that. There is no strict letter of law. If the company doesn't follow it, then they do not get criminalized for it. They do not face criminal prosecution. However, the most important thing in today's world is not the law, it's the perception of the people. If the perception of the people is not good about the company or its practices, it's unlikely that the good employees will come to that company, or customers would retain in that company if they get to know that the company is not treating its employees well. Today's word of mouth is the most dangerous thing and can also be an asset. Code of corporate governance is a system by which entities are directed and controlled. As I just told you, it is the code given by CCP to encourage segregation and fair BODs. After that, code of governance involves ensuring effectiveness of risk management and internal controls, accountability to shareholders and other stakeholders, and conducting business in an ethical and effective way. The core of code of corporate governance is ethics. So if they all you can say decisions taken by the BOD or they are being taken by the organization should comply with the ethical requirements. After that, we have got a stock exchange listing requirement. Now, listed companies across the world face additional regulatory requirements because the stock market needs to operate fairly. If the stock market if certain stock market in the world loses its confidence, the investors from there will start to pull out their money. So it's obvious, it's only obvious that stock exchange listed companies are highly regulated. A stock exchange employs rules and regulations to ensure that the stock market operates fairly and effectively for all parties involved, and that's the reason that it regulates the companies listed in the stock exchange so that they comply with the regulatory requirements. There is no unfair conduct being going on to benefit few and to discard the remaining. So such sort of behavior being discouraged by the stock exchanges across the world. The next topic is not-for-profit organizations. Now a brief introduction is given over here. Not-for-profit organizations whose attainment of its principal goal is not assessed by economic measures. They are not assessed with monetary terms measures. However, in pursuit of those goals, it may take profit making activities. Their main objective is towards the purpose of their existence. For example, if an organization purpose is for the education of the children who cannot afford the education, so their main purpose is that to fund as many students as they can towards a certain, for example, a primary level of education. But in pursuit of those objectives, it has an authority. It can, and in most cases they can pursue a profit making activity. For example, they can invest their surplus funds in a stock exchange or at a brokerage so that they can get a return. They can invest the surplus funds in their banks so they can get a return on that money. They are not restricted to getting revenue from donations only. After that, we have got objectives of not-for-profit organizations. Their main purpose is surplus maximization. It's obviously the more donations, the more aggressively they can pursue their, you can say, social objectives. After that, we have revenue maximization. Whether non-profit or profit making, revenue maximization is one of the main objectives. Usage maximization, use resources as much as possible to give the students, in our cases we are taking an example of students, to give the maximum number of students the benefit. Usage targeting, particular number of students will be sent to school with this fund in this on this much per month basis. After that, we call a full or partial cost recovery. If the funds are being provided as a loan, for example, some students can afford, some students can't afford education. If they can afford and they are lacking slightly, instead of giving them a free, it's best if we can earn from them a small amount so we can get somewhat back our amount, somewhat back the return which we are investing. So in such cases, the students who are somewhat capable, not fully but somewhat capable, instead of giving them funds freely, we can give them as a loan, and the rate of full and partial recovery system is used in the non-for-profit organization. After that, we have got a budget maximization, increasing budget year by year for the social welfare or schemes. After that, we have client satisfaction. All the stakeholders and trustees of not-for-profit organizations needs to be kept satisfied. If they do not see their funds benefiting the society, they might not be very much encouraged to keep on funding the organization. Produce satisfaction maximization. Again, the students getting the education should be satisfied with the quality of it being provided.